Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us here every week, Mike on Money, for our weekly update on everything that's going on in the market and what we see coming up in the market. And today we're going to be talking about small cap or small company investing. I've mentioned this a few times as a theme for your portfolio, and I've not really covered it too much detail. But today I want to go into a little bit more of what that means, what that looks like, and how to pick them. But as always, with anything that we cover on our shows here, remember, this is for information purposes only, not to be taken as advice. If you have any questions around small caps in your portfolio or how to use them in your portfolios, by all means, reach out to us. Happy to go through that. Go to mikeonmoney.com. Or give us a call, email, whatever is the best way for you is to get a hold of us. Happy to answer any of your questions and take a look at your specific situation. So with that, if you're watching us live today, if you have any questions, hit that Q&A button. Happy to answer them or follow up, for sure, follow up with you afterwards. If you watch it on the listening on the podcast or watch it on the replay, at home, again, mikeonmoney.com is our portal. You can go there, get access to all our videos, our podcasts, and everything else, but you can also fire in your questions there, and all my contact information is there as well if you want to give a shout. Happy to answer any of those questions. So let's dive into things this week as we document. I can't remember how many weeks we are into the pandemic. You can see from the background, actually, I'm in the office today. So we do have a lot of protocols, and it's very, very quiet in the office, but a bit of change of scenery and documenting in these videos and recordings my descent into madness through all this. But let's dive into what's going on in the market. The US trade, we're going to take a look at for March. The trade deficit's actually been creeping up, so we'll take a quick look at that. Canada trade for March as well, see how Canada's been doing. Pfizer's first quarter earnings coming out, obviously a lot of focus around the vaccine. And CVS Health, taking a look at, on the retail front of the healthcare or pharmaceutical side of things, see how they're doing. As far as the markets go so far this morning, we did see a little bit of tick down today after a bit of upside yesterday. So a little bit of back and forth. This trend's been going on pretty much through the last half of April. As people find their bearings here through the summer with the reopenings in some areas, obviously in the United States, but obviously still a lot of concerns around the pandemic around the world. Obviously, India being a hot spot, setting world records, even bigger numbers than the U.S. in their highest peaks. So still a lot of concerns around that and what that means. So we're still seeing a little uncertainty out there, but good opportunities in a lot of areas, and cover those up. The futures, as mentioned, pretty much across the board, S&P, NASDAQ. The tech, the NASDAQ side of things, the tech savvy side of things, obviously been feeling a bit more pressure this year than last year, where they pretty much could do no wrong last year, and that's just a little bit of reality setting in. How much is this repeatable? How much is this value, and how far out did the valuations get? So I still think that there's a lot of value in technology. We've covered whole videos on the topic. Areas of technology, technology is a broad word. There's a lot of ways to slice that up. And if you're going into the right areas of the markets, or you're going into the right sectors, there's still a lot of value there. But the broad-based technology, I think, has still got some overvaluation to absorb in there. As far as what we're seeing on the broad market front, Uber and Lyft, have been in this ongoing battle. So this is a bit of a replay of a story we've been following out of California, where there's back and forth between Uber and Lyft in particular, but it's really around this gig economy, right? Am I a contractor when I work for these companies, or am I an employee? Because there's very different benefit structures with those two. It's funny, I got into a big, long discussion with my 19, 20-year-old son about this on the weekend, he was trying to wrap his head around the difference. Why he thought, he saw some pros of the gig economy, but, of course, there's drawbacks of giving up those employee benefits as well, depending on your situation. So what we've seen in the state of California is this back and forth between the lawmakers and the companies fighting to, maintain this gig or contract work style of employing people versus making them full employees, which comes more cost to the firms. Obviously, they have to provide more benefits and sometimes less flexibility for the employees. So it is a bit of push and pull dependent on your viewpoint. So this fight's going to Washington. So we're now seeing Uber and Lyft getting ready for this fight to go to Washington as they lobby. This has a massive impact on these types of business profiles, because at the end of the day, if California sets a precedent or the U.S. set a precedent, that can ripple and that will completely change their cost structure or their business structure in an industry where Uber has been struggling to make money. They've been in a stage of spending money to build client base in the hopes that one day they can start turning a profit. Now they have this massive client base. They can become very, very profitable. Very common, especially in the technology front, to take this approach. If they lose this fight, that doesn't mean the end of Lyft or that structure, or the end of Uber, that structure. That just means they're going to have to really relook at how they price it out and how they offer it, and it will dramatically transform it. And this has ripple effects to other things like the Skip the Dishes and the DoorDash and Uber Eats and the likes, because they're all kind of based on that gig economy or that contract work. So we're watching that really closely as we've seen this transformation move to this type of hiring practices. And obviously it has grown some significant industries and companies through using that model. It'll be interesting to see how that progresses and whether they solidify their model or they take a step back a bit. Biden and Powell seem to be on the same path, paddling in the same direction on policy front. Basically focusing on historic course of pairing massive government spending with ultra easy monetary policy. So not necessarily this is a bad thing. Actually, look at some of these programs that the Biden administration is rolling out, whether it be the infrastructure package, the economic growth package, the green technology package. There's a lot of great things there that are building jobs for the future. And that's something we have not seen for a while in the US, even going back into Obama years. I'm not just picking on the last administration there, where the Obama administration obviously didn't have the Senate support, so putting any of these things through, they were a bit handcuffed. But we didn't even see those proposals. So we're seeing a lot of these proposals moving away from just a monetary policy, just a recession policy, but really trying to reset the trajectory of the economy completely. I do think there's a lot of positives in there now. Is it all going to be right? Probably not. Almost impossible to say. That we'd see something get it that perfectly. That being said, it is taking that longer term approach, which for a lot of elected officials, and I'm not just picking on the US here, in these 4-year cycles where, most of the time they're afraid to do something that's going to take longer term to really show results, because, they have to see the fruits of their work within the next 2 years, because they have to start, running for the next election again. So this is taking a bit longer term approach. I think very healthy. I think a lot of good things happen in there. It's going to be very interesting to watch, because they do have this unique opportunity to do this now, given that the economy hit a big reset button, right? No administration in a long time in the US or otherwise has had the opportunity to kind of hit a reset button like they've had this chance to, and really kind of set a long-term trajectory for a strong, healthy economic recovery. So I like a lot what we're seeing there, but we're gonna have to watch it closely because there will be hiccups along the way. Speaking of hiccups along the way, Berkshire Hathaway's are facing a lot of headwinds from their shareholders as it looks into its future. You know, taking some very different approaches to the post-pandemic challenges with looming inflation. You know, acquisitions everywhere. They're sitting on, last number I heard, they were sitting on $145 billion in their portfolios. Obviously, a number that most portfolios don't get to enjoy, but you know, also what they're going to do with that money. Their environmental, environmental and social disclosures have not been a strong side for Buffett. Just he's been around a long time before any of these things really came to the forefront. So getting a lot of pressure from his shareholders on that front. On the supply chain continues to bottleneck, especially in the US. The manufacturing numbers, the activity grew, but at a slower pace. But at the same time, we've seen demand continue to grow, lots of shortages as we've seen more vaccinations happen and more and stimulus packages kind of being unleashed for this pent-up demand. The manufacturing side has not been able to keep up, and we're seeing that in longer lead time, shortage for product, and rising costs, obviously pushing inflation up. So we're going to have to see how the U.S. manufacturing side adjusts to that increased demand if they can catch up. To mention, Powell is focusing on the economy's recovery, but they're looking into reports now that is being clouded or slowed a little bit by racial and educational gaps, and we saw that in the administration's some of the proposals focusing on education, focusing on food plans for young children, focusing on community college tuitions. Trying to close that gap. And it is in that, racial or minority groups that are being underserviced in those areas. And especially when we look at, what side of the economy was worse affected in the United States through the pandemic. And of course, it was those hourly workers, right? The less affluent communities. And no big surprise, because on those hourly jobs, they don't have the health plans. They don't have universal health care in the US, of course. Those people are, more hospitality, more retail focused jobs were hit harder. So Powell is really focusing on how they're going to stimulate that. We talked about this last year, that I think at that point, Biden had put it in the white collar versus blue collar category, but really how they're going to turn around those blue collar jobs, those hourly jobs, really focusing on that side of things where it was harder hit. And even as we see these economic recovery numbers coming out, that area of the economy has not seen the benefit of those recovery yet. There's still a lot of work to do in that area. So it's good to see that they're looking at it. I don't know how much time they spent on getting those reports. I think it was pretty obvious right at the forefront as to who is being affected more and who continue to be affected the most by the pandemic closures. The U.S. Supreme Court turned down or refused to revive a Wells Fargo account scandal suit. So this goes back, again, kind of a bit of a replay on a story back in the day. There's actually an interest in, I just watched recently, an interest in a documentary on Netflix on the Wells Fargo case from the employees' standpoint, looking at how, if you remember back, how Wells Fargo was opening accounts and credit cards for people, for clients under fake account names, for clients that didn't ask for them. Basically, they were putting more pressure on employees to keep their jobs. They had to open new accounts, and they were obviously employees got creative, and even management was encouraging that the creativity. And there was billions of dollars of fines back in 2016 on Wells Fargo around all this, and they had to kind of really change. But a lot of people got fired. There was class action lawsuits. There were retirement pension plans for employees that were affected due to those losses and firings, and obviously the fines. So there was a lawsuit that a class action by employees against Wells Fargo to recover some of that. It failed, and they were trying to bring it back in an appeal, and it got rebuffed by the Supreme Court. So that's not going to move forward. So we'll probably see that story die out, although not those who were affected by it, obviously. More on the acquisition in front. Meredith is to sell their TV stations to Gray Television for $2.7 billion. So just more M&A out there. Obviously, in this environment of low interest rate, low capital cost, we continue to see a lot of mergers and acquisitions. So a bigger one there, and they're going to spin off a magazine unit out of the sale. On the COVID-19 front, well, I don't know how much I can update people more about this. I think everyone's pretty much staying on top of things. Obviously, things are improving in Canada as far as the vaccine rollout in BC. Doesn't seem to be moving fast enough, but it has accelerated massively. I think we're getting to age 50 up are actually being contacted by this Thursday, I heard, for the vaccines. And of course, that's the Pfizer and Moderna's. The AstraZeneca ones have been open for, I think we're at 30 plus, although I think supply is running pretty short on that one right now. But new supplies are coming in every day, and they're speeding up the rate at which people are getting it. They're talking about 18 plus by the end of May, which is all good news. But now we have to be really cautious what we're seeing in the United States, where they've done a great job of ramping things up. But now they're running into the headwinds of people not wanting to get them. So, this is the next stage we're going to have to deal with, because that herd immunity does take, everyone trying to get it. And really, we need to look at adults going out there and get them. Not to, most of us should be considering getting the vaccine. As I mentioned, I've got mine. I encourage my first one anyway. I encourage everyone to look at it. I mean, everyone has a different situation and health situation. But to get to that herd immunity, remember, we got to get above 70 to 80% people vaccinated. And that doesn't include, we haven't even addressed, kids under 18 yet, and that's a big portion of the population. So to really get there, it's going to take a lot of the adult population to actually get vaccinated. I know it's a new thing. I recommend everyone to do their own research, and real research. Look at the stats, look at the real research, and make the best choice for yourself. But that's what's going to move us forward. Hopefully, continue to bring the numbers down. Obviously, BC is doing better as of late. Not perfect, but better. Alberta's having challenges, and Ontario and Quebec seem to be improving a little bit. Not as fast as BC, but get in there. But as we see around the world, it's not gone, and we need to continue to deal with these issues. So coming up in the markets, as I mentioned, Pfizer is expected to have their first quarter earnings. Looking for some good numbers, really get some better clarity through to future pricing around the vaccines, what that's meaning to their earnings and their overall business. And as they move forward, this is the first round of vaccines. We got the second round. And then very obviously the coronavirus is one of those ones where boosters are going to probably be required, much like the flu, on an annual basis. So how that's going to impact their ongoing earnings moving forward. So start to get the first glimpses into that. We're looking for data from the Commerce Department that is expected to show the U.S. trade deficit rising again after a big jump last month or in February. As we mentioned, the U.S. U.S. economy recovering with the stimulus, people out there buying goods and the demand increasing, and the U.S. factories not being able to keep up. So that means importing more goods from outside of the U.S., increasing the trade deficit. And as mentioned, also CVS is going to be reporting. So we're looking to take a look at how their earnings were impacted by the vaccines, because of course the certain vaccines, AstraZeneca being one, and Johnson & Johnson the other, being administered through the pharmaceutical or through the drugstores. pharmacies, sorry, and how that's going to affect. And also they're doing a lot, they're in the US, they're administering a lot of the tests and how that impacted their forecast of their needs for the year. As I mentioned, Buffett is having some challenges. So he's likely to name Greg Abel as his successor. Maybe he's thrown in the towel. He's decided, too much has changed, and he's going to, step down. I'm sure he's going to remain very active in the company, but step down as the chief executive officer of Berkshire. And this grooming's been happening for many, many years. So no big surprise on that front. Verizon's out there looking to sell off Yahoo and AOL for $5 billion. Again, not a surprise. This has been shopped around for a while. Funny enough, the price tag, some people are like, well, that's a big number. They paid more for that, picking them up. So it's kind of a loss sell-off for them. They're just not, it's not become a core part of their strategy or their business moving forward. So they're moving away from that media advertising model. Tesla continues to have challenges. We mentioned this a few times in the past. They're under scrutiny with regulators in China, so they're stepping up their engagement, trying to navigate a very different market, the regulatory market in China. For almost any industry is very different than what we deal with in what we call Western world, or the United States for sure. So more and more around the safety regulations and how they deal with service and customer complaints. So a new world for them over there, and they're tripping a little bit and see how they navigate through that. It doesn't help, of course, the tensions between China and the US when it comes to trade. Obviously, the Chinese regulators and governments put more and more pressure on US companies to do business over there, as the US has put pressure on some of their companies to do business here. Ford and BMW has led a $130 million investment into solid-state battery startup called Solid Power. So this is them securing supply for their vehicles moving forward. So I wouldn't say it's a massive investment for them. 130 million is a lot of money, but this is very common for car manufacturers to invest into companies that they see as part of their future supply chain or immediate supply chain, as they look to grow that sector, the electric vehicle sector. So, as demand increases, and we're already seeing shortages in this arena for car manufacturers. In fact, we talked about that last week on the chip manufacturing front, cars not being able to get supply. So in investing in these companies, kind of giving them priority and first rights at manufacturing of those components for their units is important for them. Another flashback story with Epic Games taking on Apple on an antitrust trial with Fortnite. So again, if you're a gamer and you're a teenager, or you have a teenager, you would know Fortnite as being a very popular game. I don't understand it myself. I've tried. I do know that kids use, and I'm told that this is a term, a cringy dance from Walmart video that's popular in it. But basically, the lawsuit's about, just for a quick recap, is as Epic has termed it, Apple's created this walled garden, this Venus flytrap type of experience for the users, where you have to use the Apple Store or Apple App Store on your Apple devices, and they demand that companies pay them to be on there, or take a big cut rather from all their sales to be on that platform. So not being a fair playing field for everybody, for developers, game developers. So Epic's taking them on. They're also taking on Google in the same breath. Although that's not at the forefront. It all started with Apple, and Apple is kind of known to be a bit more ruthless when it comes to their app store. Coming up in Canada, we're taking a look at the trade surplus, which is narrowed a bit, down to about 700 million from $1 billion the previous month, and keeping a look at that as we are hoping to return back to normal economy as things reopen again. We're looking at the value of building permits. That's expected also to slow a little bit, not drop, just the rate slow a little bit from February. Pretty much normal seasonal movement there. On the Canadian manufacturing front, we're doing better in the US. We're looking to set a record pace in April. So keeping up with the demand, which is positive for our economy as it moves forward. Bombardier is looking to put their first quarter out on their business jet revenue. It's supposed to be ahead of street estimates. So good news to hear everyone's out there buying their own private jets to get back to traveling. Thank you, everyone. If you remember last week, we did cover the budget. Buy it before next January. There's a new luxury tax coming in on your jets. So get out there and buy them as quickly as possible. Bombardier is also seeing a pretty good year on the recreational vehicles, Sea-Doos, Ski-Doos, motorized vehicles like that, as more and more people look at home recreation for their vacation dollars. It's been a good year for Bombardier, and it looks like a continued positive look forward for them as well. Another merger with the pot producer Green Thumb in the United States has entered agreement with Dharma Pharma to expand out their state exposures. They're now the second largest producer in the US with a 13 state footprint. And that's pretty much on the idea that, the talks and more likelihood that we're going to see the US federally legalize marijuana. Obviously, it's state right now, and there's a lot of problems around having it state approved and not federally approved, not the least of which being able to open bank accounts or transfer proceeds across state, because it's legal in the state, but if you transfer profits and revenue or even share your stock across state lines, that's crossing federal lines, which is breaking the law. So obviously we're seeing some Green Thumb in this case, but other producers in the United States gearing up for potential legalization federally. On the dollar front, on the Forex front, US dollar rose slightly, still within its kind of bandwidth, not really gaining too much ground. The Canadian dollar is still sitting at 81.25. It did hit almost 82 cents last week. So continue that weakness trend we're seeing there. The euro continued to recoup from their early first quarter losses through April. They continue to creep up, still dealing a little with this Brexit and obviously pandemic recovery. As we head into May and June, we're looking for more and more positivity coming out of them. And we saw the US Treasury creep back up a little bit after pulling back over the last couple of weeks. Still not at the high for the year, but a little bit of positive. On the commodity front, oil continued to head higher, north of $65, again, just on that optimism of later in this year, demand continuing to rise, again, not to pre-pandemic levels, but obviously continuing to increase, especially we see more and more people getting out to public holiday celebrations, both in China and Japan, even though they have areas remain closed. Demand forecast is looking better. Gold continued to move up and down slightly in the very narrow fluctuation band they've been moving in. Still optimistic on gold when we talk about inflation, but hasn't had a lot of movement in the last few months. So let's take a look at small cap. Why small cap? What is it? And why do I think it deserves its own little feature here? So when we talk about small cap, you've heard me mention, the value of having small cap in your portfolios. Obviously, people most likely look at small cap as being more risky, and for sure it can be, but it is also some of the fastest growing aspects of the markets or the economy, and especially in early recovery stages, because what grows quickest is the most nimble companies, the ones that can adjust to change quicker. Bigger companies may not be affected as badly or as much in a downturn, which I constantly talk about the importance of those in your portfolios, but they're slower to grow, they're slower to adapt, and they're slower to take advantage of new areas of growth. And so why it's important to look at that. When we talk about small cap, we are talking about companies, we're talking about the market capitalization of the company, the total value of all their shares or worth. And we talk about that between 250 million and $2 billion. So not your tiny corner stores. These are companies with real value and future growth potential. Stocks with market cap below 250, we usually call micro caps. And if you go below 50 million in value, those are nano caps. Both as well have healthy opportunities given the right due diligence and the right opportunities. But we're going to focus on the small cap here today. So small cap, you can trade them on exchanges. However, a lot of them can be found on NASDAQ or what we call the OTC or over-the-counter market bulletin board. And this is not surprising. These exchanges have more lenient listings, costs, and requirements. So, the cost to maintain a listing or the cost to keep your stocks, traded on the markets is real. And sometimes jump into the TSX or the S&P 500 too quickly is just extra costs and slowing your growth, money you could be reinvesting into future growth before you're ready for it or before the company's ready for it. So we generally can find these stocks more so on the NASDAQ and the OTC, and a lot of them also has moved into the TSX or the TSX Venture as they grow and continue to expand. Small caps are offered, they do offer that higher growth potential. In fact, the small cap value index generally outperforms the S&P 500 over the long term. So, more volatile for sure, but definitely offers a lot of opportunity. And they're best suited for investors who are willing to accept that volatility. If you're okay with the volatility in your portfolio, or even for a portion of your portfolio, there's nothing wrong with shaving off a portion of your portfolio and saying, hey, I want to get a little bit more growth. I want more opportunity, but I'm willing to let that percentage of my portfolio ride through that volatility in order to get that. This is what you should be looking at, or having more exposure into that. Do make sure you work with a team who knows what they're doing. I'm going to walk you through the process at our team. I work with some great individuals that I've known for more than a decade. I highly respect, and this is what they do. And they spend the time to make sure that what you're looking at is right opportunity for you. And it's not one-offs. I am going to give you some examples today that we like in the portfolios that have been highly researched and fit the criteria that we look for. But these are not one-offs to go through on your portfolios. It should be just like the large cap that I talk about a lot, the diversification that you want in that portfolio. You want to make sure that each one has its own merits. You're across different sectors, and that you're getting the right exposure. So when we look at these, the process here is what's important, and putting together a broad portfolio. Everyone should have some exposures in their portfolios. Just everyone has a different percentage depending on their risk tolerances. So let's dive into the process that my partners use and how they go about doing it. So first of all, we don't look at resource companies, so non-resource. A lot of reasons for that. Not that we don't like the resource sector overall. It's just you're dealing with commodity pricing that fluctuates and can completely change the outlook without anything to do with the quality of the company itself. So we don't look at resources. We look for high revenue growth. So companies that are growing their revenue year over year, quarter over quarter, we want to see that steady improvement. We want to see high gross margins. So are they making money on that revenue that they've got? And strong EBITDA momentum. So improving EBITDA quarter over quarter, month over month. And EBITDA, of course, stands for earnings before interest, taxes, depreciation, and amortization. So we take a look at those earnings and say, are they improving on a regular basis? And of course, we dive into what the source of that is. Because we want to see a low share count, right? So it means lower volume. So you want to be able to have someone or you yourself be very aware of how to trade low volume or low share count equities. But we like that because that means more opportunity for growth down and higher torque on the growth down the road. We want high insider ownership, so high commitment by the insiders of the company around that continued success. Reoccurring revenues. So, we talked about growing revenues, but we want to see a lot of that reoccurring. Want to make sure that, those customers are coming back, repeat customers, that they don't have to go find that revenue again, that the new customers that they bring on lend to that growth in the future. Underappreciated catalysts. So what has changed recently that hasn't really been priced in, that's going to really ramp up that EBITDA or ramp up that revenue going forward? Now, that could have been a merger, it could have been an acquisition, it could be an expansion, it could be a change in management. We're looking for a catalyst there that means, hey, yes, this stock has not been fully valued yet, but now that this has happened, we're looking for it to move forward and the market to recognize that value in the future. And an industry tailwind or a niche business that allows for the companies to maintain those high margins. And I'll give you some examples as we get into individual names. Take a look at a name, Avante Logic. So this industry is security services. They work with the travel industry, so Air Canada, transport, financial institutions. They've had great revenue growth, currently running at 100 million in revenue, 20% gross margin on that, 3 million improvements in their adjusted EBITDA. 85% of that revenue, 85% of that recurring revenue, that revenue is recurring. They've demonstrated regular organic growth, about 30%, and more potential for M&A acquisitions in the future. And the world is moving towards more security, not less, right? So more travel comes back in, other areas, look at everything around the world. Any groups getting together, more and more security in demand. Management owns 29, almost 30% of the outstanding shares. That's a good commitment, a great commitment by management there, and is currently trading really low to the EV sales. So there's an opportunity that we see out there. Again, part of a broad portfolio, checks most of the boxes, and we really see that catalyst as the economy and events start to come back into play again. Atlas Engineered Products, a Canadian home builders. So this is the engineered roof trusses, building single and multifamily dwellings. Obviously, I've talked about the construction industry and what's been happening there, the massive growth that continues, especially with these low interest rates. They had a slow last year, so that reflected in their earnings. Of course, when the pandemic shutdowns first built, we saw basically everything stall before start ramping back up. And these things are, well ordered out in advance. So the backlog into their 2021 orders is only building. 20% growth margin again. Not a reoccurring revenue, but contractor relationships are there. So still, we like that box. Growing EBITDA. Growth is driven by this housing or building boom, which we expect to continue through this year for sure. Again, almost 30% management owned, and again, a great value to share price. So small cap, really great value. These are all the same boxes we look for in the large cap. There's just so much faster growth potential coming out of the small caps. Nova Leap Health, non-medical home healthcare focusing on dementia. So obviously, Nova revenue growth last year with everything that was going on in the care homes and the 2020 shutdown. But that's where we see that turnaround potential. Looking at more than 30% pre-COVID expansion as more needs are going to have to come into place to ensure they don't have the problems they had in 2020. 34% gross margin, quasi reoccurring revenue. Obviously, there's patient turnover, but the forecast for the industry, the tailwinds for the need for senior support in society today, especially North America, is only expanding. So a lot of growth potential. 38% management ownership, and again, a good EV to sales ratio. So a lot of headwinds for growth. Value has been discounted massively, what happened last year, but that is changing dramatically as we go into 2021 and far out into the future. Last one here, Symmetrics. Again, this one's on the TSX Venture. Infrastructure components, largest North American cellular concrete provider. Cost, time, benefits for infrastructure builds. We've talked about how much money is going into infrastructure from the governments. Canada also didn't have the big headline $1.9 trillion investment bill, but all governments invest in trying to stimulate economic growth into infrastructure expended. 17% revenue growth, backlog sitting at 94 million. No recurring revenue, but reoccurring demand as more money pours into this sector and into the expansion. EBITDA contracted in 2020, but expected to double or triple in 2021. U.S. infrastructure spending, we did a whole video on the U.S. Infrastructure spending package. This is at the core of that $1.9 trillion that's being negotiated to be rolled out, but it is going to come out in demand and ownership 10%, so still a good exposure there. So these are some examples. Remember, don't take these as one-offs. Don't go buy these in your portfolios without taking a look how they can fit into a broader portfolio or what's your proper risk profiles. But reach out to us, go to mikeonmoney.com. We're happy to walk you through any of those. Happy to introduce you to the whole team that can give you a full insight into what we do when we run a small cap focused portfolio, or a piece of your portfolio that you might want to focus a little bit more on that market. As we look into 2021, as we see the economy not just growing in 2021, as we see the stimulus packages go through, but really the nimbleness of the small caps to be able to take advantage of the pandemic shift that we saw in 2020. The pandemic forcing not just existing or new companies, but existing sectors to really pivot how they do things, how they go to market. And it's these nimble, smaller caps that can really get you there. So there's a lot more names behind this to have a full portfolio. I just want to give you an example of how they can check boxes and how to look at different sectors and look for those right headwinds. But reach out to us. We're happy to go into more detail. With that, I'm going to sign off and let you enjoy, hopefully, the rest of your sunny day. Get out there on a patio. As always, great to have you with us. You can find our podcast on all of the major streaming services and our YouTube video if you want to forward this off to anyone. And I look forward to talking to you next week. Thank you all and take care.